After the recovery in business sentiment during the second half of last year stalled in the first quarter of 2025, the RMB BR Business Confidence Index declined by 5 points to 40 in the second quarter. While remaining above the average of 2023 and 2024, confidence is now a touch above the long-term average. At 40, this means only 4 in 10 business leaders in the most cyclically sensitive sectors express satisfaction with prevailing conditions, signaling a prevailing sense of caution. The survey was conducted between May 7 and May 26, with the bulk of responses coming in early. During this period, US-South Africa relations remained tense, though some optimism crept back into the market after the US paused reciprocal trade tariffs announced on Liberation Day in April. Nonetheless, respondents flagged ongoing global trade uncertainty and persistent local logistical challenges as key drags on business prospects. Let's break it down by sector. In the first quarter, a sharp rise in new vehicle dealer confidence offset broader weakness. In the second quarter, once again, we saw one sector, this time around, wholesale trade, do most of the heavy lifting. However, this time around, it was not enough to prevent the composite index from declining. While non-consumer wholesale traders remained stable, consumer goods traders reported significant sales drops, signaling potential weakness in household demand for the second half of the year. Retail trade conditions also worsened slightly from the first quarter, with confidence dropping 8 points to 42, a level mirrored by motor dealers. Still, respondents remain relatively optimistic about business conditions and sales volumes, indicating that consumer resilience persisted. In the construction sector, particularly residential, contractors have yet to feel the benefits of past interest rate cuts, including last week's. These rate cuts may not be sufficient to reverse the trend, as confidence among building contractors dropped 10 points to a near 3-year low of 35. Manufacturing confidence held steady at a low of 33. But business conditions continue to deteriorate due to weaker domestic and export demand, prompting reduced production. Taken together, last quarter's warning flashlights are flickering brighter. In line with falling confidence, activity slowed across the board. Forward-looking indicators, which have been cautiously positive in the first quarter, have since turned sour in the second quarter. While the repo rate cut will offer some relief, more decisive measures are needed to reignite South Africa's economic engine. On the local front, Budget 3.0 has brought greater clarity, and there's at least some consensus among GNU partners to continue cooperating. Globally, easing international relations would bolster sentiment, but the real catalyst lies in domestic reform. The launch of the second phase of Operation Vulindlela is an encouraging sign of government commitment to structural reform. The challenge now lies in execution.